Tom, I will kind of tee up there. You teed us up. Is on page 228 in your book, Tax-Free Wealth. One of the comments you make is in the U.S., oil and gas is one of the truly great tax shelters. Give us some details on that. What are you referring to there?
Yeah. So in any other investment since 1986, if you are a passive investor, then you can only offset your losses from that investment against passive income. That is not true in oil and gas. There is a carve out in the passive loss rules for oil and gas, so that if you invest in an oil and gas drilling program, you are a general partner, so you have unlimited liability except for insurance. So they always provide the insurance coverage if it's a good driller. But you have to be a general partner. So you can't invest through a limited liability company, a limited partnership. You've got to be a general partner. You're on the hook. If you do that, then you're not, then the passive rules don't apply. So here's why that's important, because the first year of drilling is where all the money's spent, right? And you put $100,000 to oil and gas, $80,000 of it's going to be used in the first 3 to 6 months to drill the well. And most of that is going to be intangible drilling costs. And intangible drilling costs are all the labor, everything they do other than the actual equipment and the lease itself, right? But the lease is typically paid in a royalty. You don't actually have a lot of hard costs for the lease. It's typically a royalty interest. And you're just required to drill. And what you're getting is, you put in $100,000, you could get an $80,000 deduction in year one. It actually gets even better than that, because you actually have until March to start drilling. So you can get the deduction in December and not start drilling until, you don't have to spud the well is what they call it. You don't have to spud the well until March. So they can raise the money at the end of the year for projects that they're going to, they're going to do in January, February, March, and the investors still get the deduction in the previous year. So that's what makes oil and gas. You don't have to be placed in service like you do in real estate. You don't have to have tenants. You don't have to be marketing or anything. You have to have the well, because you want to make sure that you invest in something real. But you don't actually have to start drilling until March.
Now, Tom, most of the time what I found in the tax code, it's kind of like, it's like a give and take. Like let's take, for example, IRAs. You can either have a traditional where the tax deduction going in, tax going out, or a Roth, you pay tax going in, tax-free going out. Like, it's kind of like a balancing act. But I'm waiting for the catch. Like, you get a big deduction in year one. What happens in year two, Tom?
Not a big catch, because what happens in year two, first of all, you're going to start getting depreciation. So if you had bonus depreciation, when we had bonus depreciation back in 2022, right? 100% bonus, then what we got was, we got 100% of the intangible drilling costs, but we also got 100% of the equipment costs. So people were getting on a $100,000 investment, right? And so, but that's over 2 years, because you don't get the bonus depreciation until you actually put it in service, right? Mm-hmm. So you get the 80%, say in December, and then you get the next 15 to 20% the next year. But what makes oil and gas unique, other than tangible drilling costs and the passive loss rules, is that you also are only taxed on 85% of the income. So you get what's called percentage depletion, which means that it's like depreciation, only you don't actually have to have any tax basis to get it. It's like a pretend, it's like a phantom deduction is what it is, but you get the deduction. So you get a deduction of everything you put in, and you only pay tax on 85% of what you get out. So it's really it's a really significant tax benefit in the tax law.
So you pay tax on the 85%. What tax rate is that?
That's going to be ordinary income rates. Now, what a good developer is going to do is in year 2, when you start to make money, they're going to actually convert you to a limited partner. And at that point, you won't have any self-employment tax. So you'll still have ordinary income tax, but you won't have self-employment tax. You can get away, you can get around the self-employment tax just by being a limited partner. Now, you could probably do it by putting it in your own limited partnership, but a good driller, they'll do it automatically. They'll convert your general partnership interest to a limited partnership interest as soon as the well starts producing income.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.